So when we were at the Mastermind meeting a couple weeks ago in Charlotte, one of the members, Mark Santos, had a request of everyone shares that they include some kind of default story. He's a few years into lending. He hasn't gotten to the defaults yet, but they do come with time, inevitably, in the business of lending, even with good clients. And they play out in many different ways. It can vary based on where you're located, foreclosure laws, like all the deal type, all kinds of stuff. It can play out in different ways. So we think it's helpful to put that kind of content out here. That's what we're going to be doing today. It's not all just, new loan closings and fluff, and here's the origination fee we made and the stuff you see on LinkedIn. There are real default stories behind the scenes. Most people don't share them. We are going to. Let's dive into it right now.
Thank you for joining us on this Private Lenders Podcast episode. Please note that opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, financial, and accounting professionals. If you enjoyed this episode of the Private Lenders Podcast, we would appreciate it if you could spread the word. Make sure to check out hardmoneymastermind.com, the #1 community for all private and hard money lenders.
Hey, everyone. Thanks for checking out the show. We do appreciate it. If you haven't taken a look at lender software yet, definitely recommend that you do. It's becoming really, really popular in the industry and specifically in our mastermind. The founder, Bryce Matheson, is a member of our group. Go check it out, lendrsoftware.com, and mention this podcast for a discount. All right, default story time. We're talking about a refinance that we did a couple years ago. We exited it last year, and it was for a repeat client on a couple pieces of property. We're going to go through a bunch of details, when it went sideways, how we had to get out of it. But I mean, one of the points starting is that we had lent to this guy, maybe 5 or 6 times. I just took a look,
Yeah.
something like that. Over the years, 5 or 6 times. He's a solid real estate investor, good borrower, always performed up until this deal. But it just goes to show you that things can go sideways even with repeat clients that you don't really expect will get into default. It can happen.
Yeah. Even to some of your best borrowers, like stuff happens, like people get squeezed and, they don't really have a choice. I have learned that, I learned this, I think, from the mortgage business years ago, that most people don't pay their bills, not because they don't want to or because they're lazy. I mean, some people, that's the case, but a lot of it is just they can't afford it. They're overextended. And that's what happened in this particular deal. That's what's happened in defaults in general is they can't, borrowers just can't get out of the deal. Obviously, you never want to go into a deal on the front end, enabling them to put them in a situation that they can't afford it. But, hard money rates are expensive. And, the housing market has softened, maybe even declined in some areas. So exit strategies could be challenging. So this one had other issues of why it was challenging. And, in hindsight, we can look back and be like, yeah, I kind of expected that this could have happened. But, in real time, you're like, hey, I think this deal is going to perform. I think this deal would have been fine, but it wasn't. So let's go through it a little bit. So a repeat borrower, we did a handful of deals for, came to us, had a property that he had a loan against, somewhat low loan amount, low LTV at that point. It was a 2-unit property. There's definitely challenges when you deal with more than one unit. And it was a rental property, right? So you have, in essence, 2 tenants in there. There was 2 tenants at that time, which it's great that you have 2 on the front end, 2 paying tenants that potentially are paying. You're getting rent from them. It supports the debt, which is great. On the back end, it ends up being a little bit more challenging if they stop paying rent and you can't get them out, and then you absorb their problems and you add 2 tenants that you don't want. But on the front end, it's all fun. And he wanted a little bit higher LTV on the front end than we really wanted to do. He had some capital improvements that he needed on this subject property and also another property. I'm going to introduce that here in a second. We ended up doing a loan of 180 on 260 as is value. Now, keep in mind, it's a rental property. There's no after repair value. There's only an after repair value if it's a fix and flip, and they're going to, fix it up and completely renovate it, mac it out, stage it, and resell it. That's when you can do an ARV. So this was an as is value, about 260. And that seemed fair. When we originated the loan, it was also kind of that potentially the as is value, assuming there was no tenants in there when we exited. We ran into some problems because there was tenants, so we couldn't sell it for that price. So we lent 180 on 260. And honestly, that's high for us. That's a little bit more than we would normally like to do. I mean, that's a 69 LTV. Now, keep in mind, we did have a second property that we cross collateralized, but we cross collateralized it as a second. And in essence, we were a little bit less than, I don't know, 50 loan to cost on that one. I think he owed like in the low hundreds or maybe 125, 140, something like that. And, that thing was worth 265, 280, give or take. And that was a 1 unit property. But we did have we did have a second on that, that potentially we could have gone after if needed. Um, and because we did a few deals for this borrower again, he performed. We're like, yeah, it's a little bit more aggressive than we like, but like, let's go with it. Like we've been, I think it's court. Okay. So he made his payments for a while. Everything worked out as it should. And he got to a point where it's not that the rents, like, so so just so you know, our loan was 180 and he was getting $2,400 a month from the 2 unit and then 1750 a month from the cross collateral 1 unit. So, I mean, our payment on 180 is whatever, 1900 bucks a month, and he's getting 2350. Now, that doesn't include tax and insurance, and I get all that, but he was making money. The challenge is his tenants stopped paying rent. First it was one tenant. I don't know if the second one did as well, but now all of a sudden he's got to come out of pocket, for money. And he did it for a while, and then he stopped, and it got challenged, and he got behind, and he kept up, and he got behind, and it just gets to a point where it's like, "Hey, listen, like, we gotta default this thing." And the process isn't all that quick locally, and I remember that he got really far back behind, and he was a nice guy, like, he was not malicious at all. He would have helped us with any to the day of us foreclosing on him and everything else, like, he was nothing but helpful. He felt bad, and he could, like, this was a situation he could not afford it. That's what it ended up. He wasn't being malicious. He didn't think, he was like, "You guys can have these properties. Like, I owe you money." So, which is good. Like, that's a good characteristic. And to be honest, we might even let him again, just be a little bit more conservative next time. But it got to a point, and I remember that he got so far behind. We got foreclosure fees. He gets tax notices, going to the tax sale. He doesn't have the money for that. We're stepping in to protect our interest on tax sale. Got to make sure the property's insured. So we're stepping in and paying insurance. So like our 180 loan amount, we're our payoffs well into the 200,000s at this point between late fees, regular interest, default interest, taxes, insurance. Well, he ended up selling the cross collateral that we had a second mortgage on, and he didn't get any cash out of that. All the proceeds came to us, which was about 60 grand. And I remember it was about 60 grand, give or take. And it paid all of the back due interest and everything, and pretty much like brought us back to almost current, give or take. I don't fully remember, but it was like almost current.
Yeah, I'm looking at it in the system now.
So it's like, okay, now you're back in good standing. Now keep making payments. Well, he couldn't make payments, and that was a mess. And um, so then we went back to the default process. I mean, do you want to add anything on here, or do you want me to just keep going with this story?
No, just keep going.
Okay. So we went back in the default process. We ended up foreclosing on it. The problem is now we're the freaking owners of this 2 unit property with two tenants, two, call them tenants, call them squatters, two people living in this property that we don't, he was having a hard time communicating with them because the tenants were making payments. And what ends up happening in this situation is, and this isn't the first time this has happened. And, if you're doing your loans at low enough LTVs, you can absorb these things. But if you're doing high leverage, like, you can really lose money by in a situation like this, because what ends up happening, depending on what state you're in and what area, and like this particular state and city are very, very challenging. Um, we can't even evict because, in essence, as an owner, we can't even evict on the tenant after we took ownership, because they can come back and be like, "Well, I have a valid lease," right? And then you say, "Okay, we'll make payments on the lease." Well, I can't make payments on this lease because there's upgrades and improvements that have to be made. So I don't live in a safe environment, right? Now, keep in mind, like, I don't know what this property looks like at this point. So you go
One
to the
detail on
eviction.
that.
What's that?
Real quick, one detail
Yeah.
that was relevant to why we had to take it back is his initial exit strategy was to refinance. And
Yeah.
for him to refinance was borderline, just looking at the file. And then it got worse than borderline, which is why it didn't work out. Like, first of all, his credit was like mid 600s. which is like maybe you can get a DSCR, maybe not. It's kind of like in that range where you're not sure. Second, you're not going to get a DSCR if one of your two tenants isn't paying, right? So that was another issue that came up during the term of the loan. And then three, when his loan is in default with us, you're not going to get a DSCR or any other kind of refinance approved because they're going to want a VOM. And if it's not clean, they're not doing the loan. So like all of those three factors were reasons at different times during the loan term. And he tried some a couple times that he couldn't get a refi approved. So just like a word of caution to refinance exit strategies is, I mean, now like, it's on the borrower, but you're also dependent on the tenant. Your exit strategy is now depending on a tenant paying. So like that's another like level of
Yeah.
of risk outside of your control. So I just want
And
to
the
throw that part in.
and the reason the 2 unit in essence is more risky than the 1 unit, like on the surface, it's like, oh, great. I have 2 tenants that pay rent. And if one stops, I can still get money in. Like, that's great if that works. But if they stop paying, you got 2 tenants you got to evict on and two problems and things like that. So we, in essence, our business model, we're not like loan to own or take back properties and, try to flip them ourselves. Like, we want our money working for us and we want them performing, and that's it. Like, that's what we care about. So we foreclosed on the property. We took ownership. Dealing with the tenants was kind of a pain. So we were like, hey, listen, we want to throw a ton of money into this thing and get this thing back up and running, which in order to do that, we'd have to evict the tenants and then renovate the property. They might destroy the property more than it is. And the property wasn't in awful condition, just FYI. And we're going to go through that here in a second. But we're like, there's still real value to this. We value this at 260 as is, and it probably was 260 as is, except that we had, it was hard to show the property. It needed some little work. We couldn't really sell it to a homeowner at this point. It would be like a straight investor who's going to be cash flow. So it's like, man, this value is like all the way down to like 200 now. Like, it was significantly less because of that. So we ended up getting it under contract with somebody who wanted to buy it as an investor, investment property with 2 units. And they were getting conventional Fannie Mae financing, 2 to 4 family bank financing on that. And we're like, you know, they're pretty certain that it was going to go through. And we were nervous that because it's like, God dang it, they're going to do a real bank appraisal. They're going to make us do upgrades and improvements. And at this point, like, I think the value, I don't know, the purchase price was around 200 or something like that. So they did the appraisal. It came back and we're like, we were kind of like, let's go with this offer. We want to get this thing sold immediately. Like, we're not looking to make a profit. We, in essence, just want to get all our money back at this point. Again, when he sold that second property, the cross collateral, like, we were brought current on a lot of stuff. So anyways, got the appraisal back. It needed a roof repairs to the roof, and there was something related to a sump pump and some waterproofing. And then it could get conventional conforming financing. So luckily we didn't have to repair the whole roof. It was like a $2,500 job, and then maybe another like $1,000 or so to do some waterproofing stuff, some minimal waterproofing stuff and stuff like that. So I think it was a little bit more than that. Let's call it 5,000. I don't fully remember. So we paid for that, and lo and behold, they finally got financing. Now keep in mind, when the realtor was a buddy of ours, and I was like, listen, I've never been in this property. I barely know who these tenants are. Can't get a hold of them. Like, if you knock on the door, you probably won't. Like, send some pit bull real estate agent that works in your office that's hungry and try to get inside and figure out the deal, because we'll do these improvements. I just need to know what these improvements are. And I don't feel like fighting with these tenants or going over there over and over and over. So like, the real estate agent did all the heavy lifting for us. And I was like, listen, you can charge us what we want. Like, we're pretty open about spending money on convenience when it comes to some of these things, because we could build it in a little bit, like, not trying to scrape away every extra dollar. Like, if it's going to cost the realtor a few extra $1,000 for the realtor to handle all of this mess, I'm happy to pay it, which we did. Um, so it ended up working out, and like, I don't know, maybe it was a break even deal. Maybe we made 1,000, maybe we lost 1,000. It was like very close to breaking even when all things said and done. And like, I think if you're listening or watching this, and you looked at this deal, you'd be like, yeah, it's a little bit of like somebody that might be like, that's a real good deal. 180 on 260, that's a 70 LTV. There's $80,000 in spread. Plus you have a second mortgage with a 50 LTC spread on it. The borrower's got mid 600 credit scores. They have experience. You've done other deals with them. And like we knew going into it of like, this is a little bit aggressive. Like it's aggressive. We so anyways, point being is like that deal could have been way worse. Way, way, way worse. Now keep in mind,
Sure.
the reason that investor was even able to do that deal is because they were able to get conforming conventional bank financing on that thing. So that that was helpful. Anything else to add to that? I mean, I think that's the majority.
No, that is the long and the short of it. Like we started with, I mean, sometimes borrowers that you don't anticipate can go sideways because they're speculating in real estate. Like you don't know every project they have going on. If rental properties, if the tenants are paying, if their flips are going well, if they have liquidity for whatever, right? Like they're speculating in real estate. Like that's what the business is. And sometimes it's going great, sometimes it's just okay, and then sometimes their business goes south. And it's hard to, from our perspective, know what's happening behind the scenes, right? And so that's just part of definitely residential, commercial to a lesser extent, but that's just a part of residential real estate investing is that those situations that I described, borrowers are often in, and you may or may not know about the whole thing, right? And so there's risk here. That's why we're careful on borrower underwriting, careful on LTVs. This one was like, kind of borderline in terms of, especially the loan to value. As we know, went sideways. We scraped out. We paid the lawyers and got our money back, and that was it. Live to fight another day. It's okay, but wasn't a good deal. It was not a win. This is something that hopefully the audience can learn from, because I know there's a lot of lenders that haven't hit that default phase yet. It takes some time to get there. Just statistically, like once you do X amount of loans, like you're going to have a certain percentage that are in some kind of default. And the game is, what do your exits look like? What do your default exits look like? And that tells you how good of a deal you did at the beginning, or if you did the right loan amount or whatever it is, because a lot of the industry is just about, I need to do higher leverage so that I can get a deal. And there's substantial risk there. That's important for everyone to be aware of. It's not just all, rosy like you see on LinkedIn, where lenders are out there bragging about how high their leverage is so that they can get more borrowers like that. Because the people that are doing that, they literally don't have risk. If you are in a situation in your lending company where you're responsible for the financial performance of your loans, there's real risk there. And in that case, you can't do the crazy high financing and the, everything else that the industry is talking about, because there's risk here. And if you have it, it's important to be aware. And that's a lot about what we talk about, not only in our offline meetings, but also in the online mastermind. If you haven't checked that out yet, go take a look at hardmoneymastermind.com. Feel free to join the conversation. We do monthly trainings, and there's a lot of resources in there and constant chatter about anything going on lending inside the forum. So we hope to see you in there, and we'll see you here next time on the Private Lenders Podcast.
Thank you for joining us on this Private Lenders Podcast episode. Please note that opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, financial, and accounting professionals. If you enjoyed this episode of the Private Lenders Podcast, we would appreciate it if you could spread the word. Make sure to check out hardmoneymastermind.com, the #1 community for all private and hard money lenders.